for the business. Before we begin, I do want to remind everyone that the discussion today may include forward-looking statements, and these could cause actual results in the future to differ from expectations. We do encourage you to read the published quarterly results alongside the audited financial statements for the year ended August 31, 2024, and the management discussion and analysis. All these documents can be located on the Jamaica Stock Exchange website, as well as the investor relations section of the SYGNUS Group's website, www.sygnusgroup.com. I will now go ahead and introduce our presenters for today's session. We have Chief Investment Officer and Executive Vice President of SYGNUS Capital, Mr. Jason Morris, and Vice President and apologies for that. I'll go ahead and reintroduce our speakers. We have our Chief Investment Officer and Executive Vice President of SYGNUS Capital, Mr. Jason Morris, and we have our Vice President and Head of Real Estate and Project Finance, Mr. David Cummings. Following remarks from Jason and David, we will be taking questions, and we're encouraging all our attendees to participate in the session today, submitting your questions either in the Q&A feature of the platform or on the YouTube platform, or via email, srf@sygnusgroup.com. So at this time, I will hand over to Jason to begin the presentation.
Hi, thanks, Justine. Morning, everyone, and happy 2025 to everybody. First thing, Justine, are you sharing your screen? Because I'm not seeing the presentation. I'm wondering if I'm the only one who isn't. Maybe. All right, cool. So yes, welcome everyone to SRF's Q1 earnings call for the financial year 2024-2025. And best wishes to everyone for the new year. As per usual, the financial statements, as Justin said, should be read in conjunction with the audited financial statements, so that you can get a better context for the performance of the company. So without further ado, we'll jump right into it. So the first thing I want to do is just discuss, as we normally do, the background that would have resulted in the performance for SRF during the reporting period. 4 major items I want to highlight. The first one is that, as we indicated when we did the financial year end results, that SRF was in the process of raising new capital, which coincided with, effectively, you could say, the winding down of the first investment life cycle. And we're happy to report that during Q1, we would have closed that transaction and raised 4.11 billion Jamaican dollars equivalent in 2 different tranches, well, 4 different tranches actually, but partial J, partial USD. I think we raised 1.7 billion in J and the remainder in USD. The J dollar capital raise would have been a variable rate instrument, which means that come the middle of this year, 2025, if rates remain on their downward trajectory, then SRF will benefit from that by having a lower interest cost expense, based on the fact that the Jamaican dollar asset, well, Jamaican dollar portion of the capital raise is variable rate. The USD portion was in USD, that's fixed. Different tranches 8% and 8.5%, but the J, I think at 11%, is variable. So we should see some benefits from that as rates continue to go down based on the state and nature of capital markets. So that's very good because that's a lot of dry powder that we would have raised. We would have used some of that obviously to refinance some debt that we had, but also have capital to deploy into new investments, which, as we said before, second investment life cycle. That's a major focus. Second thing is One Belmont, which for all intents and purposes, the building is completed, right? I know that the official uh, uh, status on it is that it's 99 point something percent complete, but the success here is that we would have had the first tenant occupying the building, and the tenant is is not having any complaints. They would have, started occupying the building in December, and it's a fantastic build in terms of the quality. And I leave David to provide a lot more information on this later on in the presentation. So the big thing is somebody's in the building, start to occupy it. We expect that the second tenant, who is far advanced with their interior build out, will take up occupancy sometime in the first half of 2025. So moving along quite nicely with the premier asset on the balance sheet at the moment. Third thing is that we have been promising the first dividend from SRF for quite a while. Well, not really quite a while. We missed a year effectively, and during last year, I said that we are pushing very hard to make the first dividend payment, and that first dividend payment would have coincided with the ending of the first investment life cycle. So we're happy about that. Paid this dividend in December 2024, just a couple weeks ago, 0.2012 per ordinary share. It's the first dividend, and we hope and are pushing very hard to ensure that we do this consistently and are able to increase the dividend as we go through time. So that's a big deal for the company, having laid out the strategy in front of shareholders. We're happy to finally be able to deliver on that part of the promise to shareholders who have been very patient and understanding in terms of the strategy that we are trying to execute for SRF. And the fourth thing is just to highlight that, as we wind down the first investment life cycle, just always presents into persons, because again, the way how the quarterly financials have to be reported, sometimes that can detract from the true value being created. So I just want to reiterate that over the first investment life cycle, which pretty much is winding down, right? We would have generated 19.1% average return on equity over, and this is an annualized rate of return per year average, right? Over the first investment life cycle through the end of the financial year ended August 31st, 2024. And during that period, we have exited 6.4 billion Jamaican dollars worth of investments. Second investment life cycle has started. Obviously, there's an overlap going on, right? And we did indicate that during this overlap period, things would slow down a bit in terms of deployment of capital before they start to ramp up. Now we have seen where we have raised the capital that we want to deploy to do that ramp up. And so as we go through the next couple of quarters, you're going to see that activity going on, and we have more to discuss on that further on in the presentation. Of course, the two big items that we are working on for the second investment life cycle, obviously, are Mama Bay, that beautiful beachfront property in Puerto in St. Anne, and Lake Spen, that beautiful industrial property in St. Catherine. So now to the financial performance of Q1. For the quarter, SRF would have generated a loss of 125.65 million versus a loss of 30.96 million last year. And this in terms of total investment income. And this as you see on the next slide, this is primarily being driven by two things. The first thing is that we have timing differences between the raising of the new capital we spoke about earlier, right? Once you raise new capital, you have to pay the interest expense on that. but it takes a little time to deploy out the capital that you have raised. And so we have a timing difference between the interest expense that is associated with the new capital that you raise versus, for example, the interest income that you will generate from the new capital that you have raised to deploy into new REITs and other interest income generating assets, plus those equity investments that we're going to invest in to generate capital appreciation on. So you have timing differences which would have driven the gap between interest income and interest expense in the first instance, and in the second instance, having interest expense before we're able to deploy all that capital into capital gains type transactions. So that action helped to also drive the net investment income, which was a loss of 226.96 million versus a loss of 114.88 million. Similar reason why. So the total investment income outcome is what's influencing the net investment income outcome primarily. So overall, SRF would have generated a net loss of 235.69 million versus a net loss of 132.98 million. In this net loss, as you see on the next page, we have some one-off items such as expenses related to a large exit that we did at the end of the financial year or during the quarter. We would have registered operating, well, one-time expenses relating to exit to selling, for example, Hillcrest, which won't recur in future periods. Overall, though, despite that interim result, and we are always quick to point out to investors, not to panic too much when you see the quarterly financial statements, because again, the quarterly financial statements only represent effectively interest income on any exit of assets that we do. It does not reflect any of the value that is being created, for example, in our joint venture vehicles or any assets on the book that we are doing work on that has substantial capital appreciation in it, because the cap gains that we make are effectively reported at the end of each financial year, and it is what it is. It's real estate, and that's how we have to account for it. But as you would have recognized over each financial year, you see where the year-end financial results are substantially different from interim financial results. So just want to keep that at the forefront of your mind, always when looking at the interim results. That being said, the book value per share came in higher at $23.93 versus $23.48 at the similar time this time last year, which is reflective of the cumulative unlocking of value over that 12-month horizon. Basic earnings per share came in at negative 0.72 Jamaican cents versus negative 0.41 Jamaican cents. And as always, I mentioned already that over the 5 years to the end of the financial year, just concluded in August, our ROE averaged 19.1%. Now to the next slide, which is showing the performance highlights in tabular format. First thing I want to highlight here is the fact that that net interest income that I spoke about, you see where it's negative 130.8 million, and as I said, the driver for that is the negative interest expense of 189.6 million. In that interest expense, we expect to go to the rate of growth that we saw currently. We expect that to slow down for two reasons. One, there are some one-off items in there, about 50 million one-off item in there for the quarter, and there's also the fact that for the capital that we just raised, the rate at which we raised them versus where rates are today, once we get to the period where the variable rate is exercised, and I think that exercise date is as of May this year, it will start to reflect the current interest rates in the market in terms of the link between T-bill rates and the spread over T-bill. That will happen in or around May, June of this year, and so we expect the rate of increase in interest expense to start trending down. At the same time, we would expect interest income to also start going up, because obviously we would have started deploying out that capital into transactions that were already approved and sitting on the balance sheet at much higher rates than where markets are currently. So I want to highlight that because I think that's important, the important data point to share with shareholders. Gain on disposal, 33 million from exiting a third-party real estate investment note. And then I spoke about this loss on sale of real estate investment assets. So effectively, the 64.6 million is reflective of expenses associated with the sale of one of our real estate assets on the balance sheet, which are actually recorded in the Q1 relative to when the asset was actually sold, which is again due to accounting standards. We of course would have sold that asset for almost $1.5 million more than what we would have bought it for. So it's not that we made a loss on the asset, right? It's just how the difference in the periods in which we have to report, for example, the transaction cost related to the asset versus when the asset was when we actually executed the transaction. You can skip to the next slide, Justine. So in terms of how we are running the company, very important that we continue to keep expenses down as our percentage of the total assets under management. We shared with shareholders that we have a threshold of 3.5%, which is keeping with international best practices. And as you can see, we came in at 2.7%, which means that for every dollar that we have in capital, we have in assets on the balance sheet, how much of that is going out as operating expenses, and we are keeping that within the threshold that we had indicated to shareholders. In terms of efficiency ratio, that's really measured, can only be measured on an annual basis based on the annual financial statements, because during the interim, we are reporting operating losses, so there's no way to measure that ratio. The good news is that over the last couple of years, we have been coming in within our efficiency ratio level, and we strive to continue to do so or come close within the threshold to ensure that we can, for example, maintain the dividends that we started paying to shareholders this year. Well, this financial year, but last calendar year. Moving on to investment activity. As well, the backdrop to this again is we would have highlighted that we would have a temporary slowdown in activity, right? Because we were in between two different investment life cycles, one, and two, we were in the process of raising new capital, and you can't execute a lot of investment activity without new capital. We have completed that capital raising process, at least for that for the time being, and so we are now going through the process of deploying those capital. So in terms of total real estate investment assets, that was 13.84 billion, down from 14.96 billion in the similar period last year. Of course, this would have been driven by the fact that we would have exited a number of assets on the balance sheet by selling them and getting that cash in, and then looking to redeploy that cash into new investments. So naturally, the balance sheet would decline, but you can expect that as we go through time, the value of the total assets will start to ramp up. In terms of total property investments, this was down to 9.81 billion from 11.57 billion in the similar period last year, again reflecting our exit from a number of transactions, such as 56 and 58 Lady Musgrave Road, as well as, of course, Hillcrest. Real estate investment notes, that would have gone up, going in the opposite direction, 2.08 billion versus 1.85 billion, again in keeping with our pledge to increase interest bearing or income generating assets on the balance sheet. And as we go through time, you might have some fluctuation here where we have transactions that we are in the process of exiting, and then we have new transactions that we're putting on the balance sheet. But overall, we expect this value to keep going up as we aggressively push to bring new assets on the balance sheet that are income generating. Joint ventures, this going up 2.37 billion versus 1.54 billion. Again, this is in keeping with the fact that, for example, One Belmont and other joint ventures that we have, the value of these are increasing. Obviously, in the case of One Belmont, because we now have the first tenant, we have lots of lease contracts, and as we go through time, the value of those leases will be increasing. And so as long as we have the assets on the balance sheet, then naturally the value of the asset will increase. And as we add new assets under the joint venture pillar, value in joint ventures will increase, right? So again, nothing new here, earth shattering. We're just executing on what we promised. And of course, dry powder would have increased to 1.65 billion at the end of the quarter. Well, exits would have increased to 1.65 billion at the end of the quarter versus 388.68 billion similar period last year, primarily driven by the exit of one of the assets that we had on the balance sheet. Our dry powder also would have increased to 1.1 billion due to the new capital that would have been raised versus 39.81 million in the similar period last year, and that 39.18 million would have been the indication that would have stated to everyone on the call then that our intention was to raise new capital, because obviously we needed additional dry powder to continue executing on the strategy. In terms of investment allocation, nothing earth-shattering here. Investment by asset category, we are very well diversified, and allocation by investment category. Investment property continues to make up the vast majority of the balance sheet. It's 66%, but it's coming down from what it was before. It was at one point 74%. So the tweaking of the allocation of the balance sheet continues to occur. REINs is now a decent 12%. We expect to get that up. Joint ventures 19.1%. That will continue to increase as we add new assets, new investments to the balance sheet. Before I bring David in, just a quick summary of the key strategic assets on the balance sheet. Nothing has changed much in terms of our listing of key strategic assets. One thing I want to note is that we would have sold 56 and 58 Lady Musgrave Road and generated a handsome return on those transactions for the benefit of shareholders. And what we have since done is to use this entity to then put into that entity a new asset, which is a joint venture for a new investment that we have in St. Anne, that we will be able to tell you a lot more. We'll tell you a lot more about that as we progress through time. But just highlighting the fact that where you see 56, 58 LMR Limited, this is not related to 56 and 58 Lady Musgrave Road anymore. It's related to an asset that we are holding, residential asset, beautiful residential asset in Haghold, St. Anne, which is 1.3 acres. Sea facing and hospitality exposure type asset in the residential space, and we own 71% of that joint venture. So as we work on executing this transaction, we'll provide more information on that in future earnings call. So that's the major item I want to highlight here. And then I'll hand over to David to walk us through what's happening with some of the key strategic assets on the balance sheet. David.
Thanks, Jason, and good morning, everyone. Let me start with One Belmont. As Jason indicated, this asset is a true Class A commercial building in every sense, meaning that the building has been designed with all of the latest international standards with respect to fire and safety, redundancy systems, and so on. A lot of technology being packed into this. Touchless technologies, We have several days of standby power, over 115 cameras. It really is a true Class A building in every sense. One tenant is already occupied, as again Jason already indicated. The 1%, again, you may be questioning why are we seeing 99% completion. The 1% really and truly it accounts for just to close out, the landscaping, the commission of the systems, the building management system, the access control system, and generally speaking, just closing out the project, because obviously construction is finished and we have a tenant in the building already. So just in case you're wondering why are we still reporting 99%, I thought I'd just give it a little bit of color of some of the things that we have to necessarily close out before we can actually say it is at 100%. That is it for 1 Belmont. We can move on next to Mami Bay, fantastic asset in St. Anne. And this particular asset, as indicated, as you see on screen there in the center, beautiful location. We have made very good progress and we are continuing to advance towards the decision phase. The studies that we had commissioned have also been submitted by the consultants, and very shortly we'll be able to come back to you and give you some color as to how we'll unlock the value for this particular property here. The next asset is Lakes Pen. This is our 55 acres of industrial property. You see on the screen the blue triangle diagonally opposite to the white square there, that is actually Wisynco. So give you some color. On the road that you see going just below the blue triangle, that is actually the east-west highway. So it gives you a good sense of the location. In terms of progress, since our last report at the earnings call, we have since executed a contract with a main contractor. It's a design build contract, and pending the completion of design, which is very advanced now, and are necessarily going through the regulatory approvals with the St. Catherine Parish Council, NEPA, and so on. We are anticipating that we'll commence construction in the latter part of 2025 here. And the final one I'll report on is 26 Seaview, half acre at a very, very good location. I say very good location because we're all aware of the traffic concerns in and around Kingston, and the fact that this is located where you have 3 different roads for you to leave this property from. Seaview, as you see on the screen on the right hand side, that's Seaview Avenue. To the left is Montrose, and just off screen is actually Lady Musgrave Road. So a very good strategic asset. We're still considering all our options to unlock the value for this particular property. And once we do so, we will let shareholders know exactly how we will deliver that value. I believe that's the last one. So I'll now hand back to Jason. Thank you very much.
Thanks much, David. So the final slide is just really giving you an update on where we are in terms of our strategy, which, from the very beginning, we have been very clear about how we are positioning SRF, what's our roadmap to success, which we have illustrated consistently every quarter. We provide you an update on what's happening with the roadmap, etc. So this is just another update on that path, right? 3 key things, right? The first one has to do with very simple. We are an investment firm in the real estate space, and we have a strategy. We have strategic initiatives, and we are simply need to execute our key strategic initiatives. So one of those that we had indicated was to successfully complete 1 Belmont, and as David so eloquently explained earlier, you could effectively say that the first part of the execution, you could say is completed, right? 99%, yeah. First tenant occupancy, etc. And what we are now doing is basically focusing on structuring the future exit that SRF will have. And then, as I would have updated on several occasions prior, our idea is to maximize or optimize the value that we get from the asset, right? It's a very valuable asset. It has the tenants in the building are coveted tenants. Everybody who has a class A, well, everybody who has a commercial building would want all of these tenants in their building. So we know that the asset is very valuable. So what we are doing is taking our time to structure optimally the exit. And by exit, I mean partial exit, because our intention obviously is to hold a part of this asset for income purposes and for additional capital appreciation as we go through time. So we're not in any rush. We'll take our time to do this and ensure that we optimize the returns for shareholders. So that part is ongoing. The hard part in terms of ensuring that we build it and get it within ensure that we don't have massive cost overruns, etc. That hard part is for most part completed. Get triple A tenants into the building. That part pretty much done, right? Now the other part is okay. You now need to crystallize some value from it, and we're working on that. And when we have more to provide you with on that, we will. But rest assured that we are working on that to make this a success. Second thing, so that's first investment life cycle, which for all intents and purposes, we're calling it a success, right? Second thing is Mommy Bay and Lake Spend, which is second investment life cycle. And as David eloquently explained, again, we are working on those. And when we have more to show and tell, obviously we'll update you, but with us being laser focused and executing. Third thing here is that we have to provide and deepen access to capital for people who are in the real estate space, right? And we are doing this by utilizing joint venture structures and partnership structures. And as you can see again, One Belmont is the first of the successful joint ventures, or the first of many successful joint ventures that would have embarked on. We have some other exciting joint ventures and co-developments that we are working on. And once we have more solid information to provide, obviously we will share that with you shareholders, right? And of course, part of deepening access to capital in the real estate space is to deploy capital in the third-party real estate investment notes, which is people who have projects that they want to do. They have an idea of what they want to do, or they have no idea, but they own it, or they are doing the development, right? Sorry, they're doing the development and they need our capital, and we will partner with them by providing a customized debt financing solution. And hopefully they execute those REINs good, and we are able to generate income and get maybe some upside from it in later years. So we are deepening access to flexible capital. We're not a bank, we're not lending money, we are investors investing money and expect to get a commensurate rate of return, and using whatever that development is as underlying collateral for our investment, obviously. Fourth thing that we're doing in terms of executing strategic initiatives is portfolio realignment we spoke about many quarters ago. And you can see where we have optimized the portfolio, because during last financial year, over the last 5 quarters, you would have seen we would have exited a number of investment properties, right? 56 LMR, 58 LMR, Hillcrest, right? And then take that money and convert that money into income generating assets, as well as creating new investment options such as lease participation investments. And of course, where opportunities have presented themselves, deploy some of that capital along with new capital that we have raised into new joint ventures. So, we are not beholden to, we're not wedded or are married to are in love with a real estate asset. If we think that the best way to generate the returns is, for example, to exit it to someone who have a need for it, that can optimize based on their need versus what we want to optimize, and we are not afraid to do that. So that's called being nimble in the market in which we are in. So we have demonstrated the portfolio realignment. We're at a stage now where we have some very beautiful assets on the balance sheet that we are executing aggressively on to create the next one Belmont type execution as we go through near term or over the medium term. So as we get more information on those, we'll provide those more additional information. And of course, final thing on our strategy is we would have indicated well in advance, almost a year in advance, that we're coming to the end of a first investment life cycle. Also indicated that we have second investment life cycle that we are coming up on, and that there will be overlaps between the two, and that during this period we would have a slowdown in activity. I telegraphed this three quarters in advance, almost a year in advance. And we would also, during that period, would have strategically, over last financial year, indicated to shareholders that during this overlap period would have reduced management fee from 2% to 1% in the first instance for the just concluded financial year ended August 2024. And then for this financial year, which ends August 2025, would have said that the management fee would be 1.25%, which is down from the 2% that it normally is. So then we expect that next financial year, the management fee would revert to the 2%, which would coincide with our second investment life cycle being starting to run. So just want to highlight that in terms of strategy, we are very clued up on what the strategy is. And not only are we clued up on it, we have explained this to shareholders every quarter, and we continue to explain it to you. And if you have questions around it, we can provide additional information. But just trying to give you a great sense that in terms of our strategic focus and initiatives, it's a roadmap that we have mapped out, and we're just driving the car along the road, taking the twists and turns that come with it, and picking up passengers, letting off passengers, as the case may be, in terms of paying dividends, raising capital, etc., right? That's how you execute a strategy, and that's what we've been doing. Just want to realign that with shareholders. So the second pillar of these strategic initiatives was around dry powder. As a financing and investment firm, dry powder is your blood, is your lifeblood, right? It's just like petrol for the car that we spoke about driving on the road, which is the strategy. If the car doesn't have petrol, or if it's an electric vehicle, if it doesn't have a battery in it or some way to generate energy and power, it can't run, right? So obviously, always one of the pillars is going to be around dry powder. And we spoke about two things: harvesting and redeploying. And we would have gone through that. We would have harvested. Harvested is when we exiting assets, or when asset mature after we have invested and got back our capital. Redeploy is deploying that capital into new investment, which I would have gone through earlier. And then capital raise is bringing in new fresh cash, right? And to bring in new fresh cash, obviously those investors who are giving us the fresh cash, such as yourselves, or people who would have invested in preference shares or bonds, etc., have to have confidence in bullet point number one, which is the strategic initiatives that we have and the roadmap that we have on executing. So to put into context, the 4.1 billion capital raise, which would have enhanced our dry powder and allow us to refinance debt, etc., speaks volumes. I think the 4.11 billion, that's the largest capital raise in SRF's history. So that speaks volumes to the strategic path that that SRF is on and the confidence that those providers of that capital have reposed in the firm. So we have to thank those investors who would have participated in those notes and bonds and shares. We thank you very much for your continued confidence and support. We appreciate it. Third point, I'm not gonna say much on this, right? It's just dividends! Exclamation, exclamation. I guess I've beaten this to death, so now I can breathe a sigh of relief, having delivered on the long-held promise of making that first dividend payment, and long may it continue. I won't say any more on that. So that's the end of the presentation. We'll take any questions that anyone may have on the call.
Thank you, Jason and David, for the comments. We will move into the questions now. We do have a few questions that we received on YouTube, and we also have a few that we received by email. So we'll get started with the ones that we received on YouTube. One of the first questions is in relation to dividends. Jason, any plans to increase the dividend going forward? And I'll combine it with the second question, which is there a target dividend yield based on the IPO price?
So at the moment, the way I want to answer this question, because we are in the middle, we are in between exiting life cycle 1, just starting life cycle 2. We have a slowdown in terms of investment activity, which obviously is ramping up aggressively. Like this quarter that we are in now, that activity is ramping up very, very aggressively. The way I would answer that question is, in the first instance, we absolutely intend to increase the dividend as we go through time, but of course that will be have to align with the investment life cycle and our exits, right? As I said before, we are lining up to, for example, have one Belmont partial exit, but we're not rushing. So we won't rush to exit one Belmont simply to pay the dividends, right? Even if it means that the better option is to delay the exit of one Belmont a bit and then reward shareholders with an extra bumper dividend, then that's what we'll do, right? So the way I want to answer that question is that first, on the first part of the question, yes, we intend to increase dividend over time. That was always our intention. Of course, as a company that is only now going into its 5th year, I think, we couldn't do that at the start because the way our real estate firms operate, you have to deploy the capital first, and you do all the investments and monitor the risk, etc. And then it's at the back end that you're gonna get the cash in your hand, right? So as we are in the process of getting cash in our hand, the more cash come back in our hand, the more we increase that dividend and continue to do so while executing our new projects. In terms of our target dividend yield relating to the IPO price, we have that in mind, but I don't want to share that as yet, right? Still working through some numbers to see what that target threshold should be. Again, this is just a timing issue. As I said before, one Belmont, for example, is a big giant asset, and doing a partial exit of that should bring back substantial cash flow. But we need to do it the right way. And so because of that, I don't want to commit too much in advance, right? The last time I committed, I had to wait a year before I could actually execute on my commitment. So I'm not making that mistake again in relation to dividends. But rest assured that at the appropriate time, over the next several quarters, I will communicate that, right? We have been very transparent about how we are running the firm and what our strategic goals and initiatives are. So I will communicate that once I'm able to do so, when I see a much clearer path. And because we're in an environment where interest rates have started to go down, and those interest rates going down will benefit, for example, our interest expense, etc. as we go through time. I'm sure I'll be able to answer this question over upcoming quarters. So I'm not dodging the question or hiding. I just don't have a clear enough picture in my mind to communicate something that I can stand behind. And I don't like communicating what I can't. I don't like communicating what I can't stand behind. Right? Everything I communicate, I want to communicate something and then say, hey, I communicated this, or we communicated this, and see we have delivered. That's my modus operandi, and that's how I want to keep it. So forgive me, be a little bit patient with us, and we'll communicate that in due course.
Okay, thank you, Jason. All right, so we'll move to the questions we got via email, and then we'll go back to some of the YouTube questions. First question is in relation to the new joint venture. Can you comment on this new entity that was formed and entered into during the quarter? I know Jason touched on this one a little bit.
Yeah, so basically, it's one of those ways in which, as an investment firm who's trying to be innovative, when you see certain opportunities, you have to figure out an innovative way to take advantage of the opportunity. And in this instance, this was an asset that we have on the balance sheet. And when the opportunity came in front of us for us to basically, create a JV and take a stake in that JV, we jumped at the opportunity. And the asset is located in St. Anne. It's listed as residential, but the residential is really in the hospitality space. And we think that there's a way to execute on this to generate additional value on our investment. So we're working closely with the joint venture partner to execute on this to see how we can unlock additional value for the whole partnership. I don't want to say much more than that at the moment, right? But as we go through successive quarters, whatever new developments there are that we can communicate, rest assured that we'll communicate them, as we have done with pretty much all the transactions that we have on the balance sheet. So I hope my answer satisfies the question. If not, the person can ask it in a different way, because I don't want to say more. I can't say much more than what I've just said, given where we are at this stage.
Thank you, Jason. So the next question, also from email, is in relation to the PIC shares. Have the PIC shares been issued? I believe we got this question last quarter as well.
Good question. So the PIC shares have not been issued yet. We are still waiting on the stock exchange to conclude its assessment and its preparedness to facilitate the PIC shares. Obviously, PIC shares is a new thing for our market, for the Caribbean itself. So the stock exchange has to make some adjustment in terms of its technology platform in order to facilitate the transaction that in relation to the PIC shares. So we're waiting patiently on them. They have made a lot of strides in that regards, and I think that we're nearer the end than the beginning in terms of the timeline for the execution and the listing of said shares. So we anticipate that this will occur soon. I can't say much more than that because it's really up to the stock exchange and their technology advisors in terms of their readiness and preparedness to facilitate the PIC share. So we continue to wait on that. Sometimes innovation and new things require a little bit of patience, and I think in this case that's what we are seeing. But I think it will be a good development for the market in general, as other people may want to take advantage of it. And I guess we will be able to say that we started it, so to speak. So just a little bit of patience. It's not that SRF is holding up anything. We're really waiting on the stock exchange, and it's not that stock exchange is not doing what they're supposed to do. They are, but they need a technology solution for it, and they are working aggressively on that technology solution. And I think that we are nearer the end than the beginning. So hopefully, by the time we get here for the next earnings call, we would have had that executed.
Thank you, Jason. We have another question in relation to the investment notes. Are there any purchasers or lenders ranked above SRF in relation to the collateral for the workout assets? This was mentioned in the MD&A.
For workout assets, good question, good observation. So the way that we do workout assets, well, the way that we do real estate notes, right? The underlying development is always going to be our collateral. And so to answer your question directly, we are the sole owner, or this, let me say, the collateral is 100% pledged to SRF, where you have the third party REIN, that we have workout assets. So no, there is no one who is ranked above us. We are rank 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 100%.
Thank you, Jason. All right, so we have a question in relation to Lakespen. When is Lakespen expected to break ground?
David.
Sure. Thanks, Jason. Very good question. And the reason why we haven't given a definitive answer is because for us to break ground means that we would have been granted regulatory approval from the parish council, NEPA, and so on. And as you may be aware, the process to get these approvals is not a straightforward one. We can get approval in 3 months, or it could take 6 months or 7 months. But rest assured, we plan to break ground and commence construction as soon as we have received the construction permit and building approval from the St. Catherine Parish Council. As we speak, we are currently estimating that it should take place before the end of 2025. But just kindly have some understanding and patience in us not being able to give you a date, because the process to approve the building permit is out of our hands.
Thank you, David. All right, so we'll take the last question, which is from YouTube. It's in relation to One Belmont, and I believe this one would be for Jason. Any update on a possible distribution of the cash flows from One Belmont to SRF shareholders?
Well, I think I answered that already.
Perhaps, right.
Yeah, I think I answered that, but let me answer the question because of the way it was asked. So once we are exiting One Belmont, then absolutely yes, distributions from it will be made to shareholders, because that's what we pay distributions from, right? From the exit that we make from assets that we have on the balance sheet. That's the primary. Well, obviously, real estate investment notes as well. But given the size of One Belmont, absolutely yes, at the appropriate time. And as I said before, we're not going to rush to exit One Belmont simply to pay dividends, because we think we may do a disservice to shareholders if we were to do that. We are taking our time to structure the exit appropriately, and especially because interest rates in Jamaica, my opinion anyway, are aggressively. Well, let me not use the word aggressively, because interest rates have started to go down, and I think that they're gonna go down even further. And so obviously, if interest rates are going down, and we have a creme de la creme commercial office tower with AAA tenants in it that has hard currency income generation that will increase as we go through time, then you can do the math, right? In terms of what we need to do with that asset. Yes, we need to get some cash to put in the hand of investors, but we have to be very deliberate about how we do that, because this is an asset that is gonna be it's already extremely valuable, but the value of that asset is gonna increase substantially as we go through time, especially in an environment where local interest rates are falling. So to answer the question, yes, we will pay dividends from the exit of One Belmont, but I hasten to say that we're not gonna rush to do that. Of course, we have other means to pay dividends from other assets, right? But we're not gonna rush to, for example, sell off the assets in order to make dividend payment. But once we are exiting, a partial exiting One Belmont, obviously we'll be paying dividends to shareholders from those proceeds. I hope I've answered the question that was asked.
Thank you, Jason. So that brings us to the end of our session today. I want to thank you all for joining us and for your continued interest in SYGNUS Real Estate Finance. A recording of this call is going to be available after the session. Within 24 hours, we should have it posted on our website, www.sygnusgroup.com. Additionally, the accompanying materials should be available on the website as well, and also on the Jamaica Stock Exchange website. We appreciate your engagement and we look forward to speaking to you again next quarter. Have a great day.